the only stock on our radar that could perhaps open in the red.
All right, Mark Matthews of Bank Julius Baer and Company, and Gregory Daco is Chief Economist, Strategy and Transactions at Ernst Young LLP, joining and around to take some questions. Gentlemen, great to have both of you here. Appreciate your time. Mark, let me start by sort of putting this to you. I mean, the dark shadow of the banking and financial sector turmoil perhaps is still focus number one for markets, despite the overnight relief rally. The question, though, is will this be contained, and hence will the market be able to put all of this behind, or will this fester and linger? And what's the impact for markets? Go on, Mark.
Prashant, I doubt that this is the last skeleton to pop out of the closet, but I think that what's going to happen is deposits will flow into big banks, and if you combine that with the fact that there's been an implicit guarantee for all deposits, including those above $250,000 for the entire industry, that's what really bailing out Silicon Valley Bank and Signature Bank infer. Then even if there are more skeletons and they could cause more turmoil, I think longer term, the big banks are fine. And in fact, I would say that what's happened is probably going to be a net benefit to them longer term.
Okay. Mark, good morning. Just one follow-up. The ferocity of the fall that we're seeing especially in a market like India, is quite unnerving at the moment. I mean, the market has already lost 6% this year, and we're not even through the month of March. Do you reckon that there could be a larger downside coming as we head into perhaps what could be a large recession in the US? And if yes, what should the approach be now for investors?
Well, you know, of course, that equities are volatile, and I don't know the statistic for the Indian stock market, but I can tell you that on average, since 1950, the maximum intra-year drawdown for the S&P has been 14%, which is very big. And so could it go down more? Of course it could. But I think if we turned off our computers today and came back in 6 months, the market will be higher than it is now. Unfortunately, we don't have the luxury of doing that. Neither you nor I would have jobs 6 months from now if we did that. But you know the old saying that the best thing to do is to buy and hold good quality stocks, which I think dominate the Nifty index. So, yeah, could there be more downside? Of course.
Oh, but that's an interesting point, Mark, considering how this year started off, especially for us here in India. A lot of people were just saying that, okay, should we just write off the entire calendar year? But your perspective is quite interesting. You're expecting the markets to be better off 6 months from now. Gregory, let me come to you. Good morning. Thanks for joining in. How have you read all of this news flow and all of these events over the past couple of days? And would you share that view that eventually, in the next few months at least, you expect markets to head higher?
I think we don't know. I think we are in an environment where there's still a gradual realization from the private sector, in particular in the US, but around the world, that we are likely to be in an environment of a higher cost of capital for a prolonged period of time. As you were mentioning earlier in your introductory remarks, we are still in an environment where the Fed wants to continue tightening monetary policy, will likely adopt a dual track approach to tightening monetary policy. On the one hand, continuing to raise rates, and on the other, maintaining its lending program to help stave off some of the stress in the banking sector. So that will likely continue to play out over the coming months. And there is still uncertainty as to whether the US economy will head into a recession. I think the recent developments favor an environment where credit conditions tighten further, where financial conditions tighten, and where that puts downward pressure on economic activity.
Mark, the Fed meeting on the 22nd of March, how do you think that will go? Will we get a hike at all?
Yes, we're looking for 25 basis points. We had expected another 25 in May. Now we're just saying one in March, and that's it. And that's basically because we think that, to Gregory's point, the credit activity, the economy is decelerating. There is a lag impact of higher rates, and the Fed would be, we feel, adopting a more mindful approach in light of what's happened with Silicon Valley Bank, et cetera.
You're saying this is, Mark, this is the last one? This is the last hike in this cycle?
Yes, and then we're looking for cuts in the second half.
Wow. So, all the calls of terminal rate, at 5.5, 5.75, there are still mainstream economists who have that at 5.5, 5.775%.
Well, I think there's a risk if they tighten a lot more that the economy goes into a recession, and there are a lot of Republicans in the Fed, but I don't think they want to see Donald Trump elected next year.
Gregory, what is your own assessment of which way things could go? Are you as well looking at just a 25 basis points rate hike and done? And what is the expectation as far as the Fed's 2% inflation target goes? What kind of a timeline are we looking at?
Well, I think we are certainly in an environment where the discussion next week is likely to factor in what has happened on the banking sector front, and therefore will likely be between either holding at the constant rate or increasing by 25 basis points. Had there not been banking stress, 50 basis points would most likely have been on the table. I think we have to be very careful because the market sentiment pivots very quickly. And if this situation is contained for now, we could see the Fed continuing to signal its intent to raise rates more aggressively than just one additional 25 basis point rate hike. Let's not forget, a week ago, markets were pricing in an additional 100 basis points of further Fed tightening. And the Fed and Fed Chair Powell have a strong desire to avoid having a legacy of having let inflation run out of control. So there will be likely a lean towards a more hawkish stance. And I think that's something that we'll see being repriced into markets in the coming days.
I'll surely make the 22nd meeting ever so interesting to find out how the Fed is kind of perched at this point. But Mark, quick last question to you. Even if we get a slightly more dovish, or should I say less hawkish Fed, if the underlying economy is slipping into this recession, do you still expect equity markets to rally?
Yes, in fact, most of the time the economy and the market are inversely correlated. And if you look at the years that had negative growth in the past, 3 out of 4, the stock market was up anyway. So to answer your question in short, I'm not too concerned about the economy decelerating.
All right, not concerned about the economy decelerating. There's a 25 basis points rate hike perhaps coming at the March 22nd meeting, and time to be a bit cautious, although you can continue to latch on to the large cap stocks in the index. Got that. That's the summary of the discussion we had. Mark and Greg, thanks a lot for joining in and helping us through what has been a really volatile phase for the market the last many days. Let's take a quick break. On the other side, our entire team will be joining in to help us with the top 10 stocks that you need to watch out for as we begin a brand new day of trade.